A shoeshine boy on Wall Street gives financial advice.
Buy the Radio Corporation shares, sir. They are only going up from here.
Interesting.
And nobody finds this strange. A statistician stands up and tells a room full of experts exactly what is about to happen.
Gentlemen, the numbers have stopped speaking and have started screaming. This leverage you celebrate is not wealth, it is a fuse.
They laugh at him. The next morning, the market goes up.
Thank goodness, I thought we were done for. Look at the volume.
30 days later, it is all gone. We're talking about the single greatest financial collapse in human history. Not a dip, not a correction, a crater. And the terrifying part? Every single warning sign is visible. The cracks are there.
Look at this, sir. It's gone straight through the support level. They're talking about margin calls.
People just choose not to see them.
It's marvelous, absolutely marvelous.
Because when the numbers go up, nobody wants to hear that the ice beneath their feet is breaking.
We're going straight to the moon.
This is the story of how an entire nation builds a decade of prosperity on borrowed money, borrowed time, and borrowed belief, and what happens the morning the bill comes due. And what makes it genuinely dangerous is this: the shape of this story doesn't end in 1929. It never does. Let's go back to where it all begins. 1918, America. The war ends and the world tips sideways. Europe bleeds out. Its factories are rubble, its men are graves. And across the Atlantic, America stands, clean, untouched, and hungry. For the first time in its history, the United States is not a debtor. It is the creditor. The whole broken world owes it money, and America knows exactly what to do with that knowledge. It builds. The decade roars to life with the smell of fresh concrete and machine oil. GNP climbs nearly 4% a year. Factories hum through the night. Automobiles, radios, refrigerators, things that once belonged only to the wealthy now roll off assembly lines by the millions. Productivity surges. The numbers are beautiful. The numbers are a lie. Because the workers building those automobiles cannot afford to buy them. Wages crawl. Productivity sprints. The gap between what a man earns and what the economy produces widens every single year. Quietly, invisibly, like a crack forming beneath a frozen lake. The men at the top see the numbers rise and call it prosperity. The man on the floor feels his paycheck thin and calls it life. He does not know yet that these two realities cannot coexist forever. So, the system invents a bridge, credit. Banks offer it.
Mr. Thompson, you don't need the full price today. 10% down is all it takes to bring that new radio home for your family. It's the new American way.
Credit terms reach all-time low.
Newspapers celebrate it. Buying on installment becomes the American religion. You do not need money to live like you have money. You need only the promise of future money, and in 1928, that promise feels as solid as gold.
All right, boys, lift on 3. 1, 2, 3. Heave!
Consumer credit swells.
It's still climbing.
Up another 5 point.
We'll be rich by sundown, I tell you.
But it is in the stock market where the real fever burns. You can buy a stock with only 10% of its value in your pocket. The other 90%? Borrowed. Call loans, money lent overnight, callable at any moment by the broker, flood the exchanges. The market does not just rise, it levitates. The Dow climbs 400% across the decade.
It went up another 5 points today.
Men quit their jobs to trade. Secretaries whisper stock tips. A shoeshine boy on Wall Street gives financial advice, and no one finds this strange.
United Utility is gonna split. The insider buying is huge. You can't lose. Just a 10% move.
There is no Securities and Exchange Commission. There is no referee. The floor is open, and the game has no rules. The Federal Reserve watches. In 1927, it eases rates. Cheaper money poured onto a fire already burning white hot. Then, spooked by what it has fed, it tightens. The whiplash is invisible to most. But the cracks are spreading. Industrial production slows. Housing starts drop. Valuations reach altitudes with no oxygen. In September 1929, a statistician named Roger Babson stands before a crowd and says plainly that a crash is coming.
I repeat what I have said on this platform before, that sooner or later a crash is coming which will take in the leading stocks.
That stocks will fall 60 to 80 points. The room laughs. The market ticks upward the next morning. The lake looks solid. But you can hear it groaning beneath your feet, and somewhere deep below the surface, something enormous is shifting. September 3rd, 1929, New York. The Dow Jones peaks at 381 points.
We did it, Charlie. We are rich.
This is just the beginning, old sport.
It is the highest it has ever been. The air on the floor of the New York Stock Exchange smells of sweat and paper and ambition. Men in shirt sleeves shout orders across a room that never truly sleeps. The ticker tapes unspool. The numbers climb. Everything feels permanent. Nothing is permanent. October arrives cold and quiet. Unease moves through the exchanges like a draft under a door. Selling begins, not panic, not yet, just the slow exhale of men who start to wonder if the altitude is too high. Prices dip. Then, dip again. Brokers send out the letters. Margin call. You bought that stock with borrowed money. The stock has dropped. You must send cash now, or we sell your shares to cover the debt. And here the machine turns against itself. You do not have the cash. So, your broker sells your shares.
Sell everything! Sell now!
Get out of utility.
I need a price on Anaconda. Sell it!
But everyone else's broker is selling their shares too. The selling drives the price lower. Lower prices trigger more margin calls. More margin calls trigger more selling. The spiral does not need a catalyst anymore. It feeds itself. October 24th, 1929. Black Thursday. You stand at the edge of the trading floor and the sound hits you first, a roar, low and continuous, like a building beginning to collapse. 11 million shares change hands in a single day. The ticker tape falls behind by hours, spitting out prices that are already ancient history. Men cluster around brokerage windows on the street, their faces gray, their mouths open. A rumor moves through the crowd that 11 men have already jumped from buildings.
They're jumping. A few already landed up on the cornices.
The rumor is mostly false. The fear underneath it is entirely real. The big banks intervene. Morgan partners pool millions and buy, visibly, publicly, to show the market that someone still believes.
The bankers are here.
Did you see who it is? Morgan's men.
For one afternoon, it works. Prices stabilize. Men exhale.
Well, it's stopped for now. We held the line, barely. What happens tomorrow?
The newspapers print words like controlled and orderly. The weekend passes. Men try to feel normal. October 28, Black Monday.
It's gone, all of it. 13% in a single day.
The market does not stabilize. It falls. 13% in a single session. The intervention is a bandage on an arterial wound. The banks cannot buy what millions of panicked sellers are throwing overboard simultaneously. Every purchase they make vanishes into the flood. October 29, Black Tuesday. 16 million shares. The floor is pure noise, men screaming prices no one wants to hear into telephones that cannot ring fast enough. The ticker tape gives up, trying to keep pace. Fortunes built across a decade dissolve in 4 hours. A man named something like Thomas or William or Robert, it does not matter, there are thousands of him, had borrowed heavily to buy at the peak. This morning, he owns nothing, less than nothing. He owes the bank $14,000 on shares, now worth $2,000. He sits at his desk and stares at the telephone as if it might offer him an answer. It does not ring. The Dow loses nearly 25% across those 2 October days alone. But the crash is not a single event. It is a process. It continues for 3 years. By July 1932, the Dow sits at 41 points. From the peak of 381, it falls 89%. The market does not recover to its 1929 peak for 25 years. The paper wealth of a nation, the retirement savings, the leveraged dreams, the borrowed futures, turns to ash in the time it takes the leaves to fall.
They say it'll turn around by Christmas. By Christmas, Robert, we'll be lucky to own the coats on our backs.
Control does not slip away gradually in moments like this. It vanishes. 1930. America. The silence after the roar is its own kind of violence. The stock market crash does not cause the Great Depression alone. What it does is detonate every weakness the system spent a decade pretending did not exist. The credit structure that inflated the boom now implodes the bust. Banks, which lent to brokers, who lent to traders, who bought shares now worth nothing, begin to fail. Depositors hear whispers. Whispers become rumors. Rumors become lines. You have seen photographs of those lines. Men in hats and overcoats stretching around city blocks in the gray morning air. They are not protesting. They are not angry. Not yet. They are simply trying to retrieve what is theirs before the doors close forever. Sometimes the doors close anyway. Between 1930 and 1933, over 9,000 American banks fail. Each failure contracts the money supply further. Less money in circulation means less spending. Less spending means factories slow. Factories slowing means workers let go.
My feet are numb. How much longer we gotta wait?
Heard they ran out yesterday, just after noon.
Don't say that, Bert. I ain't eaten in 2 days.
By 1933, 1 in 4 Americans who wants to work cannot find it. 25% unemployment. GDP falls between 25 and 30% from its peak. Not a dip, not a correction, a crater. The streets of industrial cities, Pittsburgh, Detroit, Cleveland, grow quiet in a way that feels wrong. The machines that ran through the night go cold. The smell of coal smoke that once meant production, that once meant men fed and children clothed, fades from the air. What replaces it is something harder to name, the particular stillness of a place that has lost its purpose. A steelworker named Frank, or 100,000 men who are Frank, wakes up on a Tuesday with nowhere to go. His wife is stretching the last of last week's flour. His children's shoes have holes. He does not understand the mechanism of what destroyed him. He knows only that it is real, and that no one is coming. He is one of approximately 15 million Americans in identical rooms. And the system that failed them, that built the conditions to fail them, finally faces its reckoning. Congress passes the Glass-Steagall Act in 1933, forcing the wall between commercial banks and the speculative casino of investment banking. The Federal Deposit Insurance Corporation rises from the wreckage. Your deposits now carry a government guarantee, and the panic of bank runs loses some of its oxygen. In 1934, the Securities and Exchange Commission is born. The referee enters the building a decade too late for 1929, but present for what comes next. The gold standard, the rigid chain tying currencies to a fixed metal reality, while the economic world screamed for flexibility.
It is settled then. We have no choice but to suspend the gold standard.
Bretton Woods in 1944 builds a new architecture from the ruble the dollar as the world's reserve currency.
We propose a new monetary framework anchored to gold. The eyes of the world are upon this assembly.
The International Monetary Fund, the World Bank, a new system constructed with the explicit memory of what happens when the old one falls. The reforms are real. The memory is not permanent. 2008. The specifics are different. The mechanism is identical. Mortgage-backed securities replace margin-traded stocks. Synthetic derivatives replace call loans. The leverage is higher, the instruments more complex. The distances between the borrower and the lender so vast that no one fully understands what they own. And then one morning in September, Lehman Brothers, 158 years old, $600 billion in assets, files for bankruptcy, the largest in American history. The credit markets freeze in hours.
Sell everything, I repeat, sell everything right now. We are getting crushed. Where is the capital wire?
The same spiral that destroyed 1929 spins again, falling prices, margin calls, forced sales, collapsing confidence, system-wide paralysis. The names change. The shape does not. Because the true lesson of 1929 is not that the system failed. It is that the system behaved exactly as built. It rewarded leverage in rising markets and then liquidated the leveraged when the direction reversed. It privatized the gains across a decade and then socialized the losses across a generation. It elevated the men who understood the game and buried the men who simply believed in it. Roger Babson warned them in September 1929. The room laughed, and the market ticked upward.
Did you see this nonsense? Babson predicts a crash. The market has never been stronger.
The lake always looks solid, right until the moment you hear it crack beneath you, and by then you are already falling through. The crash of 1929 is not a historical accident. It is a portrait. A precise, unflinching portrait of what financial systems do when left to their own gravity. Then they concentrate. They leverage. They soar past the point of reason. And then they fall in ways that the powerful survive and the ordinary do not. The reforms that follow are not solutions. They are delays. And somewhere right now, in a building with glass walls and mahogany floors, the next delay is already being negotiated.